Focus. Ideate. Innovate. Enable. Kotak Mutual Fund presents Invest Mentor in association with Network 18.
Hello and welcome to this special show, Invest Mentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. It is an investor education initiative by Kotak Mahindra Mutual Fund. I'm Sonia Shenoy. Today on the show, we talk about balanced advantage funds, which are an ideal option for a novice investor and a favorite choice of smart investors. Balanced advantage funds, also known as dynamic asset allocation funds, are a category of hybrid mutual fund schemes which manage the market ups and downs by dynamically managing its equity and debt allocation. So what exactly are balanced advantage mutual funds? What makes balanced advantage funds such a great choice for investors? How do these funds navigate the market volatility? To discuss this and more, I am joined by two guests, Harish Krishna, the Senior Executive Vice President and Fund Manager of Kotak Mahindra Asset Management, and Harish Rao, the Money Management Coach at Simple Equation. Gentlemen, thank you to both of you. Now, this is a very interesting topic. So, Harish Krishna, let me start with you. Let's begin from the beginning, right? What are balanced advantage funds and what is in it for a long-term retail investor?
In our conversations with most investors, investors do understand the benefit of compounding in a long-term asset class like equities. They nod their head when you give out scenarios of how equities compound wealth over the long term, beating inflation. But when it comes to the journey of this wealth creation, there clearly are various ups and downs, because as we all know, equities, the only one constant is volatility, the up and down of equities over intermittent periods during that long-term process. Now, essentially what we've seen is that not all investors are quite embrace this volatility. In fact, many of them get very worried with volatility as it happens, and therefore that long-term objective of wealth creation through an asset class like equities sometimes goes for a toss. It is in this context that this category of funds called the Balanced Advantage Fund or Dynamic Asset Allocation Funds come in to help the investor. Essentially, what this category does is a very simple mantra of buy low and sell high. Now, this seems very intuitive and everybody nods their head saying that this is what we all need to do. But as we will see through the rest of the show, it isn't very easy to put this into practice for the simple reason that all of us, be it a professional fund manager or an advisor or an investor, go through emotions. And it is these emotions of greed and fear that unfortunately come in the way of having a very balanced approach to investment, and which is where models approach of balanced advantage funds or dynamic category come in to help the investor navigate these ups and downs. More importantly, embrace volatility rather than get worried of volatility, and use it to your advantage so that one can actually get the benefit of buying low as well as having a discipline of selling high. So that's the basic premise of this category of balanced advantage funds.
Harish, tell us a little bit about your view on balanced advantage funds and what is the difference between a BAF and a traditional mutual fund? What would the advantages or disadvantages be?
If you have the choice of investing in just one single scheme for your all mutual fund or investment needs, then a balanced advantage fund is a really good choice. So I would say that a balanced advantage fund is a wonderful entry fund for most mutual fund investors. So if you have to just recommend one scheme in which an investor can have a really good investing experience in the mutual fund arena, then it would have to be a balanced or a hybrid scheme. Like Harish Krishnan had said, a balanced advantage fund is a type of hybrid scheme. In hybrid schemes, you have various types, of which the dynamic asset allocation or balanced advantage fund is a very, very important and a very popular module of hybrid schemes. Now, in a balanced advantage fund, you get the advantage of equity growth as well as the some amount of downside protection from the fixed income component in it. In a balanced advantage fund, each AMC has got its own process, or each AMC has got its own modeling on how to structure the equity and fixed income component. So in a balanced advantage fund, the debt equity ratio is completely left to the AMC's process, AMC's modeling, and AMC's mindset and how to give wealth creation through equities and and bring stability through fixed income. So in a way, I think if an investor has got a choice of investing in just one scheme, if the investor wants to make an entry into mutual funds, if an advisor wants to give a reasonable investment experience to a new investor, why a new investor, even a seasoned investor, then I think a balanced advantage fund fits the bill.
Okay, so Harish Krishnan, over to you now. If you can just explain to us how this dynamic asset allocation is done. How do fund managers like you switch from equity to debt? And of course, for a traditional long-term retail investor, he wants to be tension-free, he wants to be risk-free. So is this the right way to approach an investment? And how do you break it up between traditional equity mutual funds and balanced advantage funds? How much should you allocate to which category?
So different AMCs have different, broad mandates. Some of them move net equity from say 20% to 80%. Some of them move from zero all the way to 100%. Some of them move it from more, 40 to 80%, etc. So that's the broader contours of where the net equity varies for the fund. Now, how this is varied, again, there is a black box, and while each AMC has got a unique model, broadly, what we've seen is there are broadly two kinds of categories. One is a counter-cyclical asset allocation process, and then there are also pro-cyclical balance advantage funds or dynamic categories. Most of us follow the counter-cyclical asset allocation, which is when markets are expensive, you book profits, sit in debt instruments or in cash, wait for volatility to come through. Again, it can come through in, say, a month's time. It could happen in 3 months. It could happen in 6 months. But be ready with the arsenal so that you can deploy it back into the better asset class of equities when it comes to longer-term compounding, and then ride that wave of buying low and selling high. Now, how do each model work? Of course, depends from AMC to AMC. But broadly, what we've seen is that many of the models incorporate factors like valuations, be it in terms of trailing or forward valuations. And they also incorporate sentiment. It could be in terms of the market structure. It could be, how equities have worked in the recent past. It could be in terms of the volatility that equities are bringing through. Are they very low? Are they very high? It could be the breadth of the market space itself. If out of, say, 1,000 stocks, 700, 800 stocks are close to 52-week high, possibly it suggests, too much of greed. Similarly, if they are close to 700, 800 of them are close to 52-week low, it possibly suggests too much of panic and worry in the marketplace. So a combination of all of these factors are blended in together. And we see each of these factors as how they've performed over the last 20, 30 years of markets and how they have worked. And over that time frame, one gets what can be an appropriate net equity at any point of time. The idea of a balanced advantage fund is not a predictive model. Let's there be no doubt that we're not astrologers who are trying to predict what tomorrow will be for markets or what the next month will be for markets. But the idea is more to have a process so that we can be ready with the corpus of cash and debt instruments that can be quickly moved into equities coming out of various reasons. It could be geopolitical, it could be COVID, it could be just valuations being too excessive, it could be some other event in the marketplace that can bring in that volatility. But when we have a process, I think we can actually benefit from the volatility that's likely to come rather than get afraid of volatility. So that's the broader landscape as to how various AMCs move their net equity in the balanced advantage fund category.
Okay, so Harish Rao, now let's discuss who should be investing in these funds. What should the risk appetite be of an investor who perhaps wants to get into balanced advantage funds? Is there any criteria? I mean, they generally say that, younger investors should be more aggressive and should invest in equities, stay away from debt. But what would your own assessment be? What should the risk profile be of investors looking at these funds?
I think they should have a moderate risk profile and more. It also depends on the sort of risk profiling questionnaire administered by mutual fund distributors and investment advisors, and what sort of recommendation these sort of questionnaires throw up. So, but as I can see, it should be a minimum moderate risk. That means they should be ready for capital being depleted. They should be ready for extended periods of capital loss. They should be ready for periods in which the NAVs stagnate, because like Mr. Harish Krishnan said, there are AMCs that move from say 20% to 80% in equity, and all of us know how volatile the equity markets can be. The drawdowns in equity markets, can be anything from 30% to 50% depending on the event risk. So in these drawdowns, no single balanced advantage fund can, sort of cushion the investor completely. Yes, there are shock absorbers in place, and even the fund managers would take time to, recalibrate the portfolio based on what has been happening. Like Mr. Harish Krishnan said, these models are not predictive. No one could even predict. We live in a truly unpredictable world where things happen in, lightning fast speed. So at best, these funds can provide us some amount of cushion. But yes, in periods where equities suffer a big drawdown, the NAVs of these schemes can also, fall substantially. So you should have a minimum, moderate risk appetite when you enter these funds. And even the SEBI riskometer says that, it's a moderate risk fund. So that's fair enough. I would definitely recommend it to retail investors. I would recommend it, like you said, Sonia, investors who are starting off in their investment journey, who have got a long time horizon. This is really good. But I would also recommend this to something like a retired investor. For example, I do know of a lot of retired investors who do SWPs in balanced advantage funds and take home, a very tax efficient monthly income from these schemes by investing in the growth option of balanced advantage funds. So this really is a good fund which, encompasses a broad canvas of investors and, can, sort of satisfy a whole range of investment objectives.
Okay, got that. So very interesting there, but I do want to take a short commercial break. I also want to discuss the taxation angle of balanced advantage funds and what one should be picking between growth and dividend funds. So more on that coming up on Invest Mentor by Kotak Mutual Fund in just a bit.
Kotak Mutual Fund presents Invest Mentor in association with Network 18. Kotak Mutual Fund presents Invest Mentor in association with Network 18.
Welcome back, folks. You're watching this special show, Invest Mentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. This is an investor education initiative by Kotak Mahindra Mutual Fund. I have with me two guests, Harish Krishnan, the Senior Executive Vice President and Fund Manager at Kotak Mahindra Asset Management Company, and Harish Rao, the Money Management Coach at Simple Equation. Now, before the break, we were discussing the benefits of investing into the balanced advantage funds, but I do want to talk about the taxation angle as well as, between growth and dividend, what do you pick? So Harish Krishnan, let me come to you. There are two options in balanced advantage funds. Normally, there's the growth option, there's the dividend option. Tell us the difference between the two and what should an average retail investor pick?
Firstly, Sonia, even within balanced advantage funds, there are certain debt-oriented balanced advantage funds, in the sense that taxation of those schemes tend to have debt taxation. And a vast majority of balanced advantage funds now come under the equity taxation, which means that investment in those kind of balanced advantage funds entails the investor to get equity taxation. Now, between the two different options that one has, between dividend and growth, like Mr. Rao mentioned, especially in the current tax regime, if one desires of, more periodic income from the fund, then a popular option that most investors actually choose is the systematic withdrawal plan, SWP, and by investing into the growth option, which gives them a similar benefit as getting in from dividend. The only difference is that the taxation is slightly better, especially if you are in the upper taxation brackets. However, if you are at the lower end, possibly, one can consult an advisor and decide whether it makes sense to be on the dividend side. Essentially, both of these options are primarily meant to give, some kind of income to the investor. Over a period of time, it could be monthly, it could be quarterly, it could be annual, depending on what the investor desires. So that along with compounding benefits of equity as an asset class, one also has a prospect of getting some amount of income during the course of that journey.
Okay, some more technical questions for perhaps investors who are looking to get into these funds. Harish Rao, how many balanced advantage funds should you ideally have in your portfolio, and how often should you look to review it?
If you ask me, a couple of funds is more than enough based on their investment objectives and the style of fund management. Like Mr. Krishnan said, all AMCs offer balance advantage funds, but they have very different investment styles. So let investors consult their mutual fund distributors or advisors and try and figure out which balance advantage fund is really up their investment risk appetite. As far as review is concerned, an annual review is more than enough. The big advantage in a balanced advantage fund is that the fund management team does constant portfolio rebalancing, which is mandated by their scheme information document and the structure of the fund. So the investor really does not have to do any portfolio rebalancing. I would say a once in a year review, an annual review, is more than adequate in such type of schemes.
Okay, once in an annual review. And you were telling us about taxation as well. Harish Rao, what is your view on how the taxation is on balanced advantage funds? How is it different from the regular mutual funds that one invests into?
It is very, like Mr. Krishnan said, if it is having an equity component higher than 65%, then it would be taxed like a normal equity fund. Sonia, I do know of mutual fund distributors and investors who take advantage of the 1 lakh limit, tax-free limit in capital gains. Please do remember that if you earn long-term capital gains of rupees 1 lakh per annum, that is tax exempt. So I do know of MFDs as well as investors who do this sort of tax harvesting. Okay, there are people who take, say, 1 lakh for their children's annual school fees per annum, and that is completely tax exempt. The capital gain is tax exempt to the extent of 1 lakh. So that is a pretty nifty way of doing some amount of tax planning and tax harvesting. Please do invest through the growth option, and I think SWP is a wonderful way to generate a monthly income. Though it is very convenient, it is predictable, but there is only one issue in that it is not coming in the form of dividend or interest. You have to redeem your own units to generate the SWP income.
I also want to talk a little bit about the risk factors because, there are several, I'm sure. Harish Krishnan, over to you. What would the big risk factors be that an investor would have to look at before investing in a balanced advantage fund?
So I think partially it is to do with expectations. So please, like Mr. Rao mentioned, this is essentially meant for investors with at least a moderate risk. Please don't expect balanced advantage funds or dynamic asset allocation funds to magically protect all downside and participate only in the upside. At least we are not aware of any model that does that. And therefore, one should be prepared for intermittent falls. The point really is that rather than getting worried of those kind of opportunities or of those falls, can we actually embrace them by increasing allocation in a seamless, frictionless, and a more tax efficient manner, which is what the Balanced Advantage Fund comes through. An added risk, of course, is stock selection within equities. Obviously, you can have a situation where the underlying fund constituents may behave very differently from, say, what the headline benchmark indices of, say, Nifty or Sensex behave. Again, this is more a near-term phenomenon. We've not really seen massive divergences over the long term between various portfolios as well as Nifties, but again, it can bring in some kind of near-term dissonance to investors. Third is, of course, the debt portfolios also need to be carefully monitored. The debt option or the debt portion of the portfolio can be comprising of reasonably risk or less risk assets like sovereign paper, PSU paper, or they can also be saddled with reasonably high YTM products. And that is, again, something that investors need to constantly be aware of in terms of the style. So broadly, I would say it is more a question of, transient downturns and drawdowns that can happen, to have the stomach and to believe that the fund house and the fund manager are actually embracing these volatility rather than, blindly be in a position of protecting all downside. In some sense, it is like going from a slow local to a fast local. There comes a point when one needs to make that switch from a slow local of debt to a faster option like equities. And that is what the fund manager and the process is all about. And therefore, there will be that period where when markets continue to keep going down, there may be transient drawdowns. But as long as one has a slightly longer term horizon, I think the investor will realize that it is for their own advantage.
All right, we've completely run out of time, but Harish Krishnan and Harish Rao, thank you so much for joining us and explaining to our viewers what balanced advantage funds are and how they can create wealth using this option. That's it from my end. Thanks so much for watching the special show Investmenter, presented to you by Kotak Mahindra Mutual Fund in association with Network 18.
Kotak Mutual Fund presents Investmenter in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.